I want you to look at this solution to 424. It's basically putting together an income statement. And so look at this carefully. Guys, net sales is usually kind of a result of sales minus some kind of maybe discount that you gave or your sales returns and allowances. And in order to kind of shorten this problem, the accounting authors will often just throw in net sales and say, okay, this is all your sales minus all your returns and your discounts, and call it net sales. So don't get thrown by that. It is, by the way, in the test bank as part of a question is the reason I mention it. Cost of goods sold is an amount of an expense, remember, that is set aside that we put separately in order to then calculate what is considered gross profit. And why do we do this? Because keep in mind that if we very efficiently have a higher gross profit than our competitors, in other words, we manage the cost of what we sell, or we manage to sell the goods that we sell for a higher price than other companies, then we must be efficiently selling them. So those things can be analyzed by analysts and looked at as for possible investment and what have you. So I want you to realize that cost of goods sold, there's kind of a standardization by how we calculate that. We will get into that a little bit in chapter 13, but I just wanted to talk to you about it as far as being a calculation for gross profit. And I want you to take gross profit and realize that gross profit is simply the amount of your revenue over your cost of your goods that will go toward both your expenses and your income from uh, operations. So it's the amount that goes toward taking care of your expenses and your income. So that's the way they look at gross profit. So just as be aware of that. Very often we will throw expenses into major categories. Selling general administrative is very, very common. And then, of course, research and development are never included in selling general administrative. Those are separate and different. I want you to know that globally, research and development may be, like development cost could very well be capitalized and turned into assets. But in the United States, we have real hard and fast, generally accepted accounting principles that tell us that we have to go ahead and we have to expense those development costs. So research and development, guys, in the United States is always expensed, and we put it in a separate kind of category. So gross profit subtracting then your selling and administrative expenses and your research and development expenses gives you an income from operations. Now, that income is then, of course, compared to last year, the year before, and also it's compared to other companies on a routine basis. So income from operations is a distinct amount that is looked for by analysts all the time. We then take, you see, in the part B of the income statement, which is still a part of the income statement, but it is the part that is below income from operations, what we refer to as some items are always listed below income from operations. One of those may be interest expense. If you have interest on a debt, then that is very often not really considered a part of your operating business. It's something extra, if you will. So they routinely, according to generally accepted standards, we go ahead and we put it below income from operations. So we take that away, and then we have an income, what we refer to before taxes, and then we have, of course, the provision for income taxes here. And then we have a net income. So I want you to realize that income from operations and net income are two very separate things. And each one of them has usually an earnings per share amount that is then calculated based on those two incomes. And those are going to show up in an SEC company on their financial statements, and it's required. And we will actually get into here, I believe, in chapter 8, and we'll start to discuss how to calculate earnings per share. And we'll just do one or two of those, guys. It won't be a whole lot, but there is a standardization by how we calculate an earnings per share calculation based on these income amounts. So we'll get into that later, but I just wanted to kind of give you a verbal on exactly where things go and why. And I also want you to remember too that if there's ever any gains or losses associated with a sale of an asset, or maybe you have an extraordinary loss because you had a hurricane come through or something, and you have these losses and gains, well, those would all go below income from operations down here with the interest expense and the income taxes expense. So just making you aware of some things that you may see a little bit in the future. I will tell you that this particular problem, could show up on the first test, but it also could show up on a subsequent test as well. You really need to be familiar and learn this basic little way in which income statements are presented. So make sure you know this for now and in the future.